Hi and welcome back to my channel. I'm about to hit a major milestone on the channel and it's been a very interesting week. Let's go ahead and start off with where my portfolio is at. As you can see, the total value is now $61.10. My total investment is now $5,800. I did invest an additional $200 last week. With that $200, I purchased 2 shares of Coca-Cola at a price of $45.54 a piece, or a total cost of $91.08. I purchased 1 share of O, or Realty Income, at $60.03, and I purchased about $50 worth of Bitcoin. My price per coin there was $94.3963. My new Bitcoin position is 0.1537 Bitcoin, or almost 15.5% of a single Bitcoin. Of course, very happy with that, and a position that we'll talk about in a little bit. On the day, we can see I'm down $20. On the week, up $160. On the month, up $405. Over the past 3 months, up almost $1,400. Over the past year now, up $250, and all-time up $311. So as we can see, same pattern that I've been working with here for a couple months. Very slow growth at the beginning, gigantic drop off, and we're recovering and back in the green. So that's very good to see. But first, I have a very interesting article pulled up from MarketWatch about why the stock market may be in for huge gains. It's a very interesting article because it's very different. It is pretty speculative. Here we can see the opinion article. The single greatest predictor of future stock market returns has a message for us from 2030. Percentage of stock U.S. households own determines the market's 10-year return. So we can see the stock market's 10-year return potential is better now than it was at the end of 2019 for reasons having nothing to do with the shape of the economic recovery or the speed with which COVID-19 vaccine is developed. That's surprising since some market averages, such as the NASDAQ Composite, have climbed significantly higher so far this year. The improvement traces to a reduction in the share of households' financial assets that are invested in stocks. Household equity allocation is a contrarian indicator inversely correlated with the stock market's return over the subsequent 10 years. Credit for coming up with this indicator goes to the anonymous author of the Philosophical Economics blog, who wrote a number of years ago and dubbed it the single greatest predictor of future stock market returns. Notice the household equity allocation is on the flip side of the coin from household cash, sometimes referred to as sideline cash. Higher cash levels are therefore bullish, and sure enough, household cash allocations have risen markedly as equity allocations have fallen. But backtesting has shown that household equity allocation is the better predictor. In fact, according to Ned Davis research, it's able to explain 77% of variation in the stock market's return in all 10-year periods since 1951. The author says they're not aware of any other indicator that does as well. At the end of the year, the household equity allocation stood at 56.3%, close to the peak set at the market tops in both 2000 and 2007, as you can see from the accompanying chart. This is why at the beginning of this year, even before the coronavirus was in picture, the stock market's 10-year outlook was bleak. So here we can see they're running inversely. So annualized real total return over the subsequent 10 years. So down, up, and conversely, household equity allocation, almost a DNA looking graph here. Very interesting stuff. How bleak? Consider a simple econometric model I constructed from quarterly household equity allocation data since 1951 and the stock market's subsequent inflation adjusted total return at each step along the way. Based on year-end 2019 allocation, that model predicted a 10-year inflation adjusted return of negative 1.3% annualized. Note that since household allocation is not a short-term market timing tool, that's just as well since the data are updated only quarterly by the Federal Reserve and with a significant time lag. First quarter 2020 data, for example, were just recently released, but they showed that the allocation at the end of March stood at 49%, a drop of 7.3 percentage points from 3 months previously. That's the biggest quarterly drop ever seen. According to my econometric model, this reduced allocation translated into a projected real 10-year return of 2.3% annualized from the March 31st level. To be sure, the stock market has rallied strongly since then, correspondingly reducing the 10-year return projection. Nevertheless, the model is still projecting an inflation-adjusted total return for the S&P 500 of 0.5% between now and the end of the first quarter of 2030. Not good, but a lot better than minus 1.3%. Stocks look better than the treasuries, but that's not saying much. To forecast the stock market's nominal rather than inflation-adjusted return, we need to predict what inflation will be. So we've expected inflation over the next decade is 1.2% annualized, projected real return of 0.5%. So there's a lot more math in here, but the point is that this is a very interesting statistic to look at. We don't know if it's going to be super accurate in the future, but it has been in the past, and if nothing else, I think it's an interesting topic to touch on. So let me know what you think.
But first, I want to remind you to like the video, subscribe to the channel, and comment down below what you want to see next. It makes a big difference, especially in the channel's growth.
Now onto my portfolio, we're going to talk about my largest holding, SPHD. This is now trading for $33.91, which of course, as you can see, I'm down $78.31. So not good overall for me, but it is much better than it's been. This makes up exactly 10% of my portfolio with those 18 shares. So on the week, we can see it's up a tiny bit, but it's starting to fall off. On the month, only up 6.7%, but from the peak, down quite a bit. It was up almost 19%. Over the past 3 months, up 20%. Over the past year, down 20%. And over the past 5 years, only 6% growth. I think I'm going to possibly buy some more shares, but for the time being, I think I'm going to hold my position here. I think it's a decent position to hold, and I don't see a ton of upside. That being said, very high dividend, of course. I like it. This one has just been much slower to recover than some of my other stocks in the portfolio. Of course, we got to talk about Vivint Solar. I'm up $158.29, or 47% on this one all time. Of course, I keep talking about potentially buying Enphase Energy, but with Vivint Solar performing this well, it's tough to figure out exactly what I want to do. So as I said, up 47%, market value was almost $500. As we can see, average cost is down at $674. So over the past week, up 12%. Over the past month, up 36%. Over the past 3 months, up 135%. Over the last year, up 33%. And over the past 5 years now, down 24%. But again, I continue to talk in my videos about how they struggled there in the beginning around 2014, 2015. And we've seen a very slow, long recovery for them that's starting to accelerate right now. So this bottomed out around 245 on May 6th of 2016. And since then, as I've said, very slow but steady recovery for them. Price is now around $10, and I have seen projections that a target price is somewhere around $12 right now. So I may potentially buy some more shares, but I'll keep you updated one way or the other. Next up, we're going to talk about Coca-Cola. As I mentioned earlier, I purchased 2 more shares last week. My average cost is down to $52.42. I am down $48, or about 11.5% on Coca-Cola. But of course, I like them because they're a dividend king, and I think that they're slightly undervalued right now. They did struggle mightily in the first quarter, but that was due to restaurants being closed, movie theaters being closed, people staying home, tighter budgets. But I think that Coca-Cola is so diverse in the products they offer. They should be able to make up for this in the long run, and it looks like most people agree. They have a 76% buy rating here on Robinhood. So on the day, down 1.3%. On the week, up 4%. Over the month, only up 2%. 3 months, up 12%. Over the past year, down 8%. But again, I always like to show before the pandemic, peaked here at around $60. Over the past 5 years, up 17%, which is interesting that even with these recent struggles, they have done fairly well in the long run. Next up is Sony. We've got a very interesting story here. Sony did release images and talk a little bit more about the PlayStation 5, which is something that of course will affect their stock greatly. It's something that I've talked about very vaguely in the past, but moving forward into the next 3-4 months, it's going to be really a huge indicator of how their stock and how the company as a whole performs. So you can see total return is $31 here, or up 27%. Over the past week, up 4.18%. Over the past month, up 12%. 3 months, up 27%. Over the last year, up 35%. And over the past 5 years, up 135%. Of course, I really like this one. Very high buy rating. I think especially with the PlayStation 5 coming out, could be very interesting to see. But let me know if you disagree or if you think that I've hit the nail on the head on this one. The last actual stock to talk about today is Charles Schwab. Of course, they've struggled, much like many other companies, but their struggles started before the pandemic. Interestingly enough, Robinhood, as a direct competitor, has now hurt Charles Schwab. But they've got a lot of other problems. It could be undervalued. 56% hold rating here. So we can see I'm down $13.50 on this one, or almost 16% now. Average cost is $43.35, and I own 2 shares. So of course, market value around $73. Over the past week, we can see it's up 3%. Over the past month, it's up 10%. 3 months, up 18%. Over the last year, down 11%. And over the past 5 years, up 11%. I think I'm sort of at a crossroads with this one. I can continue to purchase more shares, or I can dump the shares that I have. But it's such a small holding in my portfolio that doing nothing is potentially an option. I don't like to do that. I really want to be steadfast in the stocks that I'm purchasing. So let me know what you think about Charles Schwab. Last up, we're going to talk about Bitcoin, of course, the largest holding in my portfolio. Equity is now $14.3074. It makes up 23.43% of the portfolio, and the quantity is, as I mentioned before, 0.1537. So that average cost is slowly going down, or rather slowly going up, depending on where the price of Bitcoin is at. But the average cost is now $91.40. Return is shrinking as it's fallen in the past week. So the past week, we can see it's down 1.14%, but on the month, down 4%, and over the past 3 months, up 72%. Over the past year, up 2.5%, and over the past 5 years, up 3,800%. Problem here for Bitcoin is going to be, when does it break out? Of course, my prediction being that it breaks out towards the second half of next year. And actually, the more that I'm reading, it seems like the earlier Bitcoin breaks out, the earlier it's going to bust. So preferably, for many reasons, I'm hoping that Bitcoin's price stays within probably $15,000 this year, because if that growth can be stunted on the front end, it means there will be more growth on the back end, which of course means that the price that I sell at would be much, much higher. Let me know what you think about Bitcoin, or if I should be invested in altcoins. Let me know. It's an interesting topic. Thanks for watching to the end of the video, and I'll be back with another one next week. Thanks.